Okay, we're going to do example problem P-3-3 on page 115 of Governmental and Nonprofit Accounting and Theory. And we're just going to be handling some various general fund transactions. We're preparing the journal entries for those transactions for Farmer County General Fund, and also we will show any effects, if there are any, on the capital assets or long-term liabilities fund. Okay, so we have, first of all, we levied property taxes for $9 million with uncollectible taxes estimated at $50,000. So we're going to have, it's a levy, so we're going to have a tax receivable. And we're going to debit that for $9 million. Okay. Since we have an allowance, or we expect some of that to be uncollectible, we are going to set up our allowance, if I can type, for uncollectible current taxes. And the amount is going to be $50,000. Our balance of $8,950,000 will be shown as our revenue. So that's our tax revenue. And this is obviously to record the levy of property taxes. At this point, there is no effect of this transaction on our general capital asset or general long-term liability accounts. So let's go on to the second transaction. Tax collected before the due date totaled $7,500,000 of current taxes and $320,000 of prior year taxes. So we're going to obviously debit cash in our unrestricted fund, $7,820,000. We have credit taxes receivable. Boy, I am really struggling spelling here. Receivable current. So out of those current, we had $7.5 million. And then we're going to have our delinquent taxes. So our taxes receivable delinquent for $320,000. And those can go for quite a while, by the way. So you can see those showing up from there. I still, at Mark, I still occasionally, we do the accounting for by state, I still occasionally, when houses get sold and there was a tax levy on for the by-state tax, I've actually received money from that, even though it's been closed for quite a few years. Third, we have our purchased supplies on account for $110,000. So we're going to debit our expenditures for $110,000, and we're going to credit, or we have a debit, we need a credit, so we're going to have what's called vouchers payable. And notice we use vouchers payable instead of accounts payable. Okay, so there we have it, and there's no effect on our general capital asset or general long-term liability accounts for that transaction. Let's look at number 4. Purchase equipment costing $198,659, which was vouchered, or is like vouchers like a payable. So we're going to have expenditures for $198,659. We're going to have vouchers payable for $198,659. Okay, we're also going to increase our general capital assets for equipment by that $198,659 amount. So that would be in our general capital assets and general long-term liabilities account. So we're going to increase there, and that would increase, of course, our net assets in that particular fund. So let's look on to number 5. Issued a 9-month 10% note to Jones National Bank on September 30th to raise $300,000 to provide for temporary cash shortfall for in the general fund. So we got a short-term borrowings going on. So we're going to have cash to pay our bills, and we're going to have a short-term note payable for $300,000, and this is to basically we're recording this to borrowings to keep our cash flow going. And so it's handled pretty much just like a business would handle such an item. It's not going to affect our general capital asset or general long-term liability accounts because it is a short-term liability. Item number 6, we loan $90,000 from resources available for general purposes to the Self-Insurance Internal Service Fund. Repayment is required in 4 years. So we are going to have what's called an advance to the Internal Service Fund of $90,000, and we're going to credit cash, obviously, for $90,000. Okay, so the transaction's not going to affect the general capital asset or general long-term liabilities account. It will mean, though, we'll have a non-spendable fund balance amount and less unassigned fund balance in the general fund. Okay, so basically it's a designated type of fund. So we've made a transfer there. We're not going to be able to spend that $90,000 because it's internally restricted with funds. Okay, so it's a non-spendable fund balance. Number 7, we paid salaries of $5,800,000. Accrued salaries at the end of the year totaled $100,000, while at the beginning of the year they were $75,000. Okay, so we need to figure out what we're dispersing during the year. So we're going to have expenditures, and we're going to calculate by taking our, well, obviously we're going to have our $5,800,000. Then really what it's going to work out is it's going to be, we're going to increase it by the difference in the two accruals. So our original, our year-end accrual was $100,000, but we already had $75,000 in there, so we'll subtract that out. So our net amount is going to be $5,825,000. Since most of the rest were all of our salaries of the $5,800,000 were paid in cash, we will record credit for cash. And obviously this would be going on an ongoing basis. You know what I mean? And then we're going to have our accrued salaries payable account will be $25,000. Be credited by $25,000. So we're getting that balance from $75,000 up to our $100,000 that it is now. So it kind of works almost like an allowance for bad debts. Same type of thing. So we owe $100,000 of salaries that were actually accrued in the current year. Okay, so we will go on from there. Number 8. Contributed $82,000 of general fund resources help cover the cost of a new water distribution lines installed by the county's water department, which provides services for a fee that is intended to recover the cost of providing the services. So we're going to have a transfer. So we're going to transfer to the enterprise fund of $82,000, and we're going to have cash and $82,000. Again, we're only showing the effects on the enterprise fund. There would not be any effect on the general capital asset or general long-term liability accounts. The enterprise fund then would record this as a transfer in from the general operating fund. Let's look at number 9. We received $5,000 from the Economic Development Special Revenue Fund because general fund resources have been used to pay a bill of the Economic Development Fund earlier in the year. General expenditures were recorded when the bill was paid. Okay, so we're receiving a reimbursement basically. So we're going to increase cash for $5,000, and we're going to credit the expenditure. So we're just washing that out because it's not a true expenditure. It was a mistake, right? So we're just getting a reimbursement from our special revenue fund for an expense that should have been handled in the special revenue fund, but it was mistakenly handled in the general fund. Okay, so number 10, paid $1,750 to Central Printing Internal Service Fund for printing services used by the general administration of the county. So we are going to have expenditures of, what was it, $1,750. We're going to have a credit for $1,750, and that credit is going to be cash. Okay, so, and that's basically recording a payment to our internal service fund for our services rendered. Okay, so really handled just like a normal transaction there. It will not obviously affect our general capital asset or long-term liability fund. And then finally, let's look at number 11. And we have record any necessary accruals at the end of the year. Well, what do we need to accrue? Well, we've already handled the salary accrual, so we don't need to deal with that. But we do have our interest on that short-term note. So we're going to have expenditures for an amount, and our amount is going to be calculated by taking our $300,000 note times 10%, because we're paying at 10%, and it's 9 months, so we're going to be doing, times, parentheses, 3 months. It's an annual rate, so it's going to be times the 12. Divided by 12. There we go. So $7,500. So again, we take our $300,000 note, it's a 10% annual rate, and divide that rate basically into 3 months, and take that times our principal balance, $7,500. There's expenditures, cash. Our accrued interest payable is going to be $7,500. It is $7,500, and we already did that. Neither one of these affect the general capital asset or general long-term liability accounts. So these are some select transactions for our general fund. Again, most of these are very straightforward for you.